Geoff, welcome to the show.
Thanks, Tim. Good to be back on.
Hey, love having you. Love talking about this subject of what makes a good investment. One of the questions I had is what makes a bad investment, and we can determine what that looks like and then stay away from that. But just maybe to add a little more context on really how we got to this topic of what makes a good investment is we look at a lot of companies all day long. And our objective at Growth Inc. is to help them grow, is to give them the infrastructure that they need so they can increase enterprise value and help them determine the roadmap of how long they intend to stay inside of this business. Because their business, in many cases, is their number one asset. So naturally, they would want to invest in that asset and continue to grow and siphon the cash out of that and put it into other investments and work with good folks like yourself on the registered investment advisory side. But I just want to, like, as a general stroke, get a sense of what makes a good investment. When you hear that question, what comes to mind?
There's a lot of things come to mind. I can have this conversation for endless amounts of hours, which stocks I like, which companies are undervalued, where I would put my money right now. Um, but I would be looking at it from my own perspective. I'm probably not going to touch those investments for many years, many potentially for not for decades. Whereas someone who's listening to me might think, oh, I like those stocks too, but they might not need to take that amount of risk. They might be able to put their money in something risk-free like the treasury market, treasury bills, for example, like Warren Buffett is building a big cash position right now. If they have a ton of money and they can earn 5% risk-free that affords them the lifestyle they want to live, they shouldn't be listening to me about which stocks I like or why I like gold and silver. So good investments and bad investments, you know, the first thing would be you have to look at your circumstances and what makes sense for you. I think that's the most important starting point. And then you can get into good versus bad, like which companies are overvalued or too risky. There's like the like GameStop, for example. I wouldn't ever get involved in that, even if some people make some money. Um, but I think, not to use the cop-out answer that it depends, I do think, you want to take a step back, take inventory of your situation, your business, your family, your needs, and then you go from there.
Yeah, well, having a long lens is important. But let's talk a little bit about the theme of control.
Hmm.
So there's a lot of folks, they say, well, if I put my money into a 401k, it's locked up and I don't have access, or I can't pull it out without getting dinged. Um, or if I put it into a REIT, I can't touch it for 7 years or something like that, right? So they feel like because they don't have control, that it may not be a great investment. But maybe
Hmm.
that's more psychological than actual. What do you think about that?
I think it's a valid point. We see it with a lot of owner operators. They bet on themselves. They run a business. They've grown it, 10 or 100x from where they started, or really infinity, because what they had was just an
Yeah.
idea when they started. So to then tell that same person, lock up all this money in this fund or this private asset, it is a big jump. So there is a psychological element there. I see it a lot. Professionals in the real estate world, they know when they take over that asset, they can touch it, they can walk around inside of it. Um, they know how to add value to it.
Hmm.
So when I talk to them about the stock market, they have this feeling of like, well, I don't know what's going on over there. I'm just going to stay in my lane.
Right.
So there's more than one way to do it. There's more than one way to build wealth and to protect assets. Control is a factor. I would say, for example, if you get in like as a limited partner, as someone who's high net worth, you cut a check for $100,000, for example, for this early opportunity. You just never know if they're going to dilute shares or if some other institution is going to come in and take control. And then, suddenly it's that asset or that equity position is losing value and there's nothing you can do about it. So it's another one where you have to consider what you're doing and understand the risk that you're taking and just never, if you are someone who likes to have control, never put yourself in that position where your money's going to be tied up in something for 5 or 10 years or longer. If that's not something you like, let's take a different approach, different strategy.
Yeah, it's easy to confuse the word good with safe.
Mm.
So if it's safe investment, it's a good investment, right? Well, you could say, well, a CD is safe, uh, but maybe something that's like high risk doesn't mean it's bad because you can have exponential growth. You could fund the next unicorn, right? It's just probably a higher risk tolerance, right?
Absolutely. So that turns into a diversification conversation where maybe you want to say 70 or 80 or 90% of your portfolio would be, say, in an index like the S&P 500.
Right.
And then you have your 5 or 10 or 20%, whatever your risk tolerance is. With that portion, you're going to say, hey, let's roll the dice here. Where you have like a chance of losing a lot of money, but your reward to the other side is asymmetrical. We would say you have a high reward. Like it could be you could lose all your money, but you might 5x.
Right.
If you do that enough times, you're going to make money, statistically speaking. But still, if you don't have to take that risk, then don't. So if you do, just make sure you're doing it with a safe amount of money in your circumstances.
Yeah. And along the diversification, which I definitely wanted to touch upon, when we speak with business owners, a lot of times they're all in on their business. They're
Oh yeah.
100% in their business. Now, you made a point about having control, like the real estate guy. He can physically
Hmm.
walk and touch his building, and it's like, I own this asset, I own this dirt. And a lot of times business owners feel that way, which is, I know if I hire a new employee or hire a new sales rep or put more money into marketing, I know how that's going to print more money. But there, we were talking about this earlier, that there's a point where your growth starts to diminish. Maybe you were getting, 20% year over year, then that goes down to 15, then you maybe find yourself at 5%, and you're like, okay,
Sure.
I think we know what this thing is, and if we're not going to grow through acquisitions or some other strategy, maybe we need to diversify outside of our business or find other ways to double down and grow this puppy.
Yes, exactly. I don't want to get too technical because it'll turn into a lullaby. I'll put the listeners to sleep. But we do things when we do financial projections and analysis. We'll look at certain metrics like return on equity or return on invested capital. And what we're measuring is for every dollar we put into the business, what return can we expect? If it's 20 or 30 or 40 or 50%, then sure, let's put money in. We've stress tested this model. We know we're going to make, let's say, 30 cents every dollar we put in. Let's do it. Now, we're making good money. We could go from 2 million in EBITDA to 10. And then, like you mentioned, if the margin does start to compress, now it's a conversation. Okay, we've grown this business. The margin's coming down. We're still stable. We're still profitable. But now maybe, let's take some time to regroup. Let's pull some money out of the business. Now let's set up our external assets and other stocks, bonds, real estate. And, you start to regroup and consider if you want to go back into that growth phase, if you want to think about exit planning, if you want to look at mergers, acquisitions. Um, it's all relative. Like it's all based on an order of operations. When you're in a hyper growth phase, take advantage, capitalize, of course. But then, sure, at some point you start to stall out, you regroup. And then let's take some chips off the table. Let's make sure that if the business starts to lose its profitability, then we have assets elsewhere. Now we're diversified. We can think more clearly. We're not all in on this one asset that may work out, it may not. So, part of it is what you can do to be responsible. Another part of it is, it's stressful running a business. It's good to have something to fall back on if things start to take a turn for the worse.
Yeah, I know you love the topic of tax strategies as well.
Oh
So,
yeah.
beyond what makes a good investment is how to keep more of what you earned as
Hmm.
as a strategy, correct?
Yes, of course. The tax code favors business owners. There's a lot that you can do for your business and for your household. Um, we can get into those strategies, although I think it's somewhat separate topic. Um, but yeah, it does start to be something that where it's a mistake that I identify a lot of the time is people think about the conversation of taking chips off the table or paying themselves. They don't consider that they could have something like a solo 401k plan or a self-employment plan where you can put as much as $70,000 away, tax deductible, into a retirement vehicle that then you could do into like a mega backdoor Roth strategy so that it would never be taxed again. So there's things you can do to build wealth and then make it grow on a tax deferred basis that if you just are in the habit of doing these things, even in your growth phase, just to pull some out and put it away, uh, it's going to benefit you long term.
Yeah. We should definitely do another video on that and do a very deep dive. And if you're watching
Yeah,
this and you want to hear more about that, leave a note in the comment. If we get enough comments, we'll do a heavy deep dive on that. Uh, well, going along this theme of what makes a good investment, let's. Does it matter how good the investment is if you have bad habits?
that's a great question. Ah, gosh. I mean, you can get lucky every once in a while. Like the first guy who sits down at the poker table, he's like, I don't know how to play, and then suddenly he wins like 10 hands in a row. They say that's the worst thing that can happen to you because now for the rest of your life,
Yeah, yeah.
you're going in thinking, I can just stumble backwards into winning a bunch of money. So, sometimes you get lucky, but I would say over time, if you have bad habits, like for example, right now, if we look at the stock market performance year to date, a lot of policy turmoil, and you're hearing about inflation or recession risk or this global policy uncertainty, people get scared. And now that, say, their stocks are down 10 or 20%, now they're selling. Whereas at the start of the year, you could have looked to rebalance your portfolio, take some risk off, build a new strategy, and then, going back to Warren Buffett, he's been building a cash position for the past few years. Um, so not being emotional, not um, don't wait till your portfolio loses value to then start making a plan. It's like don't wait for that moment of extreme tension and stress and then reach out. It's like, you got to be proactive, have a plan, stick to it, and remove that emotional or that impulse or any of those bad habits because that's how you will underperform in the
Yeah.
long term.
Yeah. We see it so often on the business side where a life event occurs and that it's a negative life event and it forces the business owner to now make these decisions, uh, a divorce, a death, disease, something along those lines. And now they say, uh, I have to get out. I have to take pennies on the dollar. Oh, I wish I would have, right? We hear a lot of that. So kind of going back to those good habits, it's like one of the best habits you can have is just planning. I would say the second one is jumping on calls with folks like yourself and just having a free conversation that just explores. This is, hey, here's all the things that we can do. I want to take a step back and talk about the good investments. Everybody benchmarks. I mean, everybody. Many people benchmark the S&P, 8 to 10, right? And then they gauge whether an investment is good or bad based upon that benchmark. How do you feel about that?
Yeah, this happens all the time. So I'm having some flashbacks here. Um, so at the top, we said, you want to be very cognizant of your circumstances. Let's say, you have $10 million to invest and you're a pretty frugal person. You spend, let's say, $100,000 a year. So you have 10 million. The treasury market's paying about 4% right now. So you can make $400,000 risk free and you spend about $100,000 a year. Why would like what
Right.
what do you need risk for? So if you know what your budget is, if you know what your lifestyle goals are, and if you know that you can be on track to achieve all those goals, and then you can transfer that wealth to your children or to beneficiaries or to philanthropic causes, build legacy, that's more important than beating an index, which is a fairly arbitrary thing for
Yeah.
most people because it doesn't really have to do with their goals. Another way of looking at it is if you want that 8 to 10% per year, then just be in the benchmark. You don't have to beat it. Don't waste all your time and stress out over the fluctuations in the stock market on a weekly or monthly basis. Just buy a low cost ETF of the S&P 500 and let it ride. So there's multiple ways of looking at it, but you don't have to beat the index. It doesn't, you're not a hedge fund. You're just a person, you're a business owner, you have your business, you have your family to take care of. Focus on that. And if you can do that, then more power to you. You don't have to take unnecessary risk.
That's very wise. I'm paraphrasing here for you, but it's almost like everyone should have their own personal index,
Mm,
and then they should try to beat their personal index. But at least that's the foundation versus some index that they heard about in the news or their neighbor is getting or Warren Buffett's getting. It's like that's semi irrelevant. Just create your own personal index and then try to do the best you can within that framework.
yeah, I like that. I've never, I'm going to steal that. I'm going to say we're going to build personal index here. We know that we're on track to achieve all of our goals if we make 4 or 5%. So let's focus on that. Then if we beat that, awesome. We
Awesome.
have a surplus.
Right. Yeah. Okay. So let's take this all the way back. Let's do some recaps here. Um, what makes a good investment? First and foremost, having a personal index, so you know what you're trying to beat, what you're trying to win.
Mm,
Uh, Having good habits, and part of that good habit would be planning and making sure you're having conversations with smart people to make sure you have a good plan. Um, Knowing that investing in your business, being your number one asset, is smart if you have a
hmm
mechanism for how you're printing your own money. But
hmm
the second that starts to lull, you kind of need to recalibrate, is what I heard you say.
Yes,
What am I missing? What else should be added to that?
that's a good recap. Yeah, I don't know if we necessarily need to add anything, just emphasizing planning and doing these planning exercises. Recalibrate, I like that word.
Mhm.
Um, Not that you are going to make a change, but having the habit, having an advisory team or a board of advisors or people that you trust that are in your corner and just talking to them, air your grievances if that's what you need to do, or um, I would say every month is probably not a bad idea to have a phone call, even if it's just touching base for 10 or 15 minutes. And then quarterly review, make sure you're on track. If there's anything that needs to be done or optimized. Um, on an annual basis, at the very least, do some rebalancing, take some profits off. Nobody ever got poor by taking profits. So yeah, just building those habits, building those muscles, getting those repetitions in. I think I wouldn't add to the list. I just emphasize the importance of those items.
Okay. As a bonus question, as a wrap up here, what what makes you feel uneasy or anxious or nervous or scared when someone mentions these words to you? When you hear something from someone else, you're like, oh, that just kind of gives you a pit in the stomach. What do you hear where you're like, I just don't like hearing that?
Yeah, so sometimes I'll get a phone call from someone who's um, exploring the market, let's say, like around tax season, or it could be that the S&P's done, 20, 25% for a couple years in a row, and they're not happy that their portfolio only did like 18%. And I'm like, oh gosh, like they're putting me in a situation where I have to say, well, I'll beat 18, and
Right, right.
it's not it's not really my job. Like there could be actually greater upside if we refine their tax strategy, or if we figure out a really good growth plan for their business. We might make more money than by focusing on 18% versus 20% versus 25. Um, so like getting your priorities in order is really helpful. Um, but yeah, like I it's tax season right now. I'm getting phone calls from people saying, um, I think I'm gonna have a huge tax bill. What can I do? It's like, well, do you have a time machine? There's
Right.
not much we can do now. It's 2025. Um, so there are things where I think we've mentioned this. It's like you have that triggering life event, and then you start making the call. Um, so I would just say, to be proactive is the preferred approach for anyone in professional services, especially in accounting or estate planning or wealth management. You can't do anything retroactively, or there are I should say, there are very few things you can do retroactively. So I get a little uneasy when people are saying like, I can't believe this guy had me in bonds when I should have been in Nvidia. It's like we might be missing the big picture here.
Yeah, yeah. All right. Well, thank you for the time always. We'll put your contact information down below. If you're new to this, please like, comment, subscribe, follow along, and definitely reach out to Geoff Sokol. He's a wealth of knowledge and loves having conversations with folks that are asking the big questions.
No, no pun intended, right? That I'm a wealth of knowledge.
You're a wealth
But
of
yes,
knowledge.
happy happy to speak with anyone on a complimentary basis, see what's working for you, see what we can improve upon. And if we can work together, great. If not, still happy to help. So feel free to reach out. Don't be shy.
Awesome. Thanks, Jeff.
Thanks, Tim.